Welcome, everybody, to The Long-Term Investor. Today with me is Christine Benz, Director of Personal Finance for Morningstar and Senior Columnist for Morningstar.com. She also co-hosts a podcast, The Long View, which features in-depth interviews with thought leaders in investing and personal finance. Christine has been named to Barron's list of 100 most influential women in U.S. finance multiple times, and she has also written one of my all-time favorite personal finance books, 30-Minute Money Solutions, a step-by-step guide to managing your finances, which is easily one of my favorites, and I have put it on all sorts of book lists over the years that I've compiled for the Wall Street Journal and Forbes, just because it's so actionable and well-organized, and it really did have an outsized impact on my own personal finance philosophy. So, Christine, welcome to the show. I really appreciate you sharing your time with me and the audience.
Well, Peter, thank you so much for inviting me. I'm a big fan of yours and a big fan of your book as well. So it's a treat to be here with you.
You know, we had actually never met, but when I had reached out about the book, and I was very nervous because truly this book that you had written, I felt like had an outsized impact, in part because it showed me how one dedicated piece of time towards your finances can just have a huge impact over time as it starts to compound the benefits of those decisions. And today we're going to walk through a 2022 financial to-do list for listeners. And it's a little bit of the same way where all of the things that are important to getting your financial house in order are somewhere on this list. And within the book, you can jump around. And I also know that a lot of people, when they start something, they don't always finish. But before we jump into this to-do list, I was just hoping that we could get our listeners to know you a little bit better and have you tell us about Morningstar, the company, as well as your role within the firm.
Right. Morningstar is an investment information firm. We also do some investment management in a separate division. But the part of Morningstar that I work for is responsible for Morningstar.com, which is our website for individual investors. We have research on a lot of different aspects of investing. So we have folks who research mutual funds and exchange traded funds and a really large team of researchers covering individual stocks. And then we have people like me who focus on how to put the pieces together. So how to create a sensible portfolio, how to keep your plan on track on an ongoing basis. I'm part of quite a small team of researchers focused on portfolio construction, personal finance, and retirement planning. So it's really fun. It's broad, but the idea is that we help investors make smart decisions with their money.
And when I'm reading your work or listening to you speak, it usually feels like you're addressing the do-it-yourself investor. Is that right? Or am I making the wrong assumption there?
Well, I think that you're right, and that Morningstar.com is mainly geared toward do-it-yourself investors. But I will say, Peter, that a lot of them do have financial advisors. And I think financial advisors would say that their best clients are the clients who are educated about these matters, who are educated partners. So we certainly do have a lot of readers who work with advisors, but want to be an engaged participant in that discussion.
Well, your column is always at the top of my list when something new comes up. And The Long View, your podcast, is on my regular subscription. So all of you listening here, be sure to subscribe to that. The guests are wonderful on Christine and her colleague Jeff Patak's show. So, but I do want to jump in this 2022 financial to-do list. It's the beginning of the year. People have their New Year's resolutions. They're feeling energized. And I couldn't think of anybody better to help point people in the right direction and down that path. And you actually wrote a column just a few weeks ago doing exactly that. But as I'd mentioned just a moment ago, oftentimes people get started and they don't really finish. So before we walk through some of the items on your list, Christine, what do you think if someone's only going to do one thing would be the most important thing to do to start 2022 off on the right foot?
I think the key thing to start with is sort of what I would refer to as kind of a wellness checkup. Check up on whether your plan is on track based on some of the key metrics. So if you're someone who is still saving for retirement, if you're working and saving for other goals, perhaps college funding or a home down payment or whatever that might be, do kind of that starting wellness check to see, is your savings rate on track? And I guess suppose if there's been a silver lining within this pandemic, it's that many people have stepped up their savings rates. So look at whether you are saving a reasonable amount given your salary. I think for many people, 15% is kind of a good starting benchmark. For higher income folks, I would set the bar higher because a bigger percentage of their spending is discretionary. So you might be looking at like a 20% or even higher savings rate if you're a higher income person. Also do some tracking on how much you've managed to save so far and see whether that looks reasonable given where you are in your trajectory toward retirement or whatever other goals you might have. I like these savings benchmarks that Fidelity puts out annually where they have a multiple of your current income that is a savings target that you might reach for on an ongoing basis. They're not perfect, but I think this can seem really black boxy, knowing sort of where to start in terms of whether you've saved enough so far. So I think that's a good reference point that people can use. And then for people who are retired, the key metric of their financial health is their spending rate relative to the amount of assets that they've amassed. So do a periodic check on that. I think annually is a good time to check up on whether your spending is reasonable given your portfolio size.
Well, those are all wonderful things, obviously hitting people in different life stages. And usually it's January. You've probably had a compensation discussion. Perhaps you've gotten a raise, and you mentioned that savings rate. The rule of thumb, and I don't know why it's been this, there must be math supporting 10, 15%, 20%. Yeah, that was ingrained in me right out of school as I went to work for an investment professional. And that's all they talked about. Certainly the way that you build up to that, if you can't do it all at once, if you didn't start out the gate making that contribution, is using some of those raises, using some of those windfalls. The other thing that you point out that I think that Fidelity study that kind of gives you some benchmarks of how much should you have can frighten you into action if you haven't done anything. But the numbers, if I remember correctly, are really based on pretty reasonable assumptions. The key one, though, being that you started early. So I would say if you haven't started early, that's, don't get down on yourself. But I will tell you, Christine, one of the most common questions I get from prospective clients before they've hired us is, well, how am I doing relative to everyone else? And so I would agree with you. That's at least a decent benchmark. It's not everybody else, but it's something.
Exactly. And the other thing I think about, Peter, is I think sometimes people do get demoralized if they feel like they're sort of a late start investor. One frequent issue that people run into is that they've spent the early years of their careers raising kids, saving for college, buying homes, upgrading homes, all of that stuff. And so by the time they hit their, say, mid to late 40s or early 50s, they might feel like they're hopelessly behind. And I guess I would take heart in the fact that those can be really terrific years to play catch up, where college is in the rearview mirror, your kids are stepping out on their own. And so I would urge people at that life stage to not feel like, oh, it's hopeless, why should I bother? Those are really terrific years to be super savers. Sometimes you have a married couple where one spouse has been sort of the primary child caregiver and he or she is freed up to re-enter the workforce. Those can just be fabulous years to make up for lost time.
Well, and so I asked you what's the most important thing, and no surprise, it is the first thing that you had listed in January was to look at the goals, see how you're doing. And again, if you're retired, tracking that spending rate. I will note that Mint.com has added a feature where it shows how you are spending relative to others like you, and it kind of groups you by net worth and spending categories. So I'm not necessarily a huge believer that people have to track every single line item of their expenses if they don't want to. But by all means, it's sort of like if you know you're very healthy, people always equate health and money. You don't need to count calories, but if you count calories, even when you are healthy, you do uncover some things from time to time. And Mint sort of allows you to do that in the background and then pull it up at a time like this to just get a sense of where things have gone. And oftentimes our spending creeps in different directions without us really knowing because it's so gradual at a time. So I really do like that advice. The other things that you have in January, so I wasn't sure if that would be the most important thing. It was sort of what I felt like was. So it's interesting that you chose that. But yet another thing in there for January you have is find your best return on investment. And this has always been really important to me. It's sort of like order of operations. Which account should you save for? Or should you pay down debt versus save for retirement? How do you think people can best organize themselves to find the best return on investment or the capital allocation of their savings?
I think this is so under-discussed, Peter. I think that investment professionals tend to spend a lot of time on asset allocation. So how do we invest the assets in the portfolio? But preceding those asset allocation decisions are what I think of as sort of primordial allocation decisions. So within every household, there is some amount of money that you have flexibility to do something with. And so the point is put some math around those choices that you're making. And to illustrate this, I often use a reference point from my own life, where several years ago, my husband and I had our 15-year mortgage, and we had an interest rate of, I think it was 2.875%. And we had shopped around. My husband had shopped for the very best mortgage we could get. And we were thrilled with that interest rate at the time, which was quite low. Now I think that there have been some lower rates come online. But we were looking at our household balance sheet and saying, well, look at this. We had the luxury of having the funds in our Vanguard taxable brokerage account, where our interest rate was really quite low on that municipal money market fund that we had. And we looked at that and said, well, gosh, does it really make sense to have this account that is earning, like at the time, less than 1.5% when we have debt over here where we're paying 2.875% to service it? So for us, the answer was easy. Let's pay off that mortgage and let's sort of retire that debt and have fewer ongoing expenses. And in turn, we can put more into our investment accounts on an ongoing basis going forward. So that's just a simple illustration. For some households, some of these decisions will be kind of in the gray zone. So you probably want to split the difference. In fact, I would argue for a lot of households, prepaying mortgage is not a good return on investment, especially for younger people. If they can put money into their company retirement plan and into a Roth IRA and invest that aggressively, well, over time, that will be a better return for them than mortgage pay down. But I think that it's worth being thoughtful about how you're deploying your household financial capital. Then you can think about how you invest those investment assets, but start there and make smart decisions about those household capital allocation choices.
I would agree with you on the mortgage side. So many people, it's very emotional because they see this big debt number and it hangs over their head. And especially if inflation is going to be greater than the rate of your interest, well, there's very little mathematical case. But as I always say, we don't live in a spreadsheet. So you do have to make decisions that allow you to sleep at night. And in the show notes for all of you listening, if you visit thelongterminvestor.com, I'll go ahead and link to a resource on invest and pay down debt, which kind of does an order of operations based on the expected return from making those payments, as well as how to contribute in order of account for retirement. Because I do think most people, when they're ready to pay off the house, I start asking, have you maxed out your 401k? Have you contributed to IRAs or HSAs? And it's not to say that you absolutely have to do those things prior to paying the mortgage. It's just pointing out the mathematical difference, as you said, Christine, especially for people who are maybe in their 30s and 40s and have many, many decades ahead to compound those extra returns. Whereas if you're nearing retirement, going into retirement debt-free, is usually quite a nice benefit. Good to have those fixed costs under control. So the math maybe works out a little bit differently.
Right.
We're mentioning the retirement plan contributions. That's actually the last thing that you have in January. And not every year, but most every year, the limits nudge up. And I'm just going to go ahead and read it straight from your article. The limit for 401ks in 2022 is $20,500 for anyone younger than 50 and $27,000 for those 50 and older. IRAs are the same, where it's $6,000 for people under 50, $7,000 for people over 50. And you don't have HSAs listed here. They're a little bit later, and I definitely want to dive into those, but those limits have nudged up by about $100. So looking at these contributions, I've seen in the past, Christine, you go through an order of operations of what retirement accounts you think deserve most priority. Maybe share some of your thoughts on that.
Sure. So I think if you're funding retirement accounts, start with your company provided retirement plan, assuming you have one. Do a little bit of due diligence on it to check its quality. But the starting point is if you're getting those matching contributions from your employer, go ahead and at least fund that retirement plan up to the match. And then that's where the due diligence comes in. If it's a really good plan, we'll continue to max it out because it's easy. The contributions come right out of your paycheck. If you find that your plan is not that great, so maybe you have expensive investment options, or you discover that there are a layer of operating expenses that will cut into your return, then I think switching over to an IRA will make sense. Whether you use a traditional deductible IRA or a Roth IRA will depend on a lot of different variables, one of which is your income level. That will be a determinant of whether you can deduct your IRA contribution or whether you can use a Roth, or whether you need to use a maneuver like the backdoor Roth because you earn too much to make a direct Roth IRA contribution. But I would say start with retirement plan, make sure you're earning any matching contributions. If your plan is great, continue to fund it up to the max. If it's not that great, go to a Roth. And then if you're a super saver and you're maybe you have a not great company retirement plan, then maybe you can look at some ancillary savings vehicles like HSA, you mentioned, Peter, and I know we're going to delve into that, or even a taxable brokerage account where you can invest tax efficiently within that account.
Well, let's actually go into the HSA
Sure.
since we're talking retirement accounts. And I know you have it listed a little bit later in the progression of things. I mentioned we'll bounce around a little bit. But the HSA, I've talked about on the show a number of times for listeners who've followed along. And you get a tax deduction when you put money in. The money grows tax-free. And then you pull the money out in retirement or at a later date, as long as it's for health care related expenses, it's tax-free. And one of the beauties of this system, if you can afford to contribute to that account and pay your medical expenses out of pocket as well, is that you can just save those receipts over time. And the apps are getting much better at letting you document receipts. I have a couple folders full of receipts, and I'm this year for the first time committed to just snapping a picture within my app so that I can trust that when I get to retirement. And I was in physical therapy for an ankle sprain last year. Well, I'm going to make withdrawals and use those receipts from my physical therapy as the reason that I get to pull that money out tax-free, even if I'm using the money to take a vacation or go to the grocery store. So really a powerful account. I guess, Christine, how do you envision people using these in terms of alongside their other retirement accounts?
Yeah, I think that the use case that you outlined, Peter, is beautiful. I think people say, wait, what? I can at a later date pull tax-free from my HSA, but in fact you can, assuming you have the documentation that you've been talking about. But I do think it's important for people to outline how they anticipate they'll use the health savings account. So you can use the HSA as it was originally intended, which is kind of a spend as I go type account. So one might use it to cover healthcare outlays as they're incurred. Alternatively, people could use it in the way that you're talking about, which is that you don't touch the HSA assets. You use non-HSA funds to cover your healthcare costs as you incur them. And that way you can invest the HSA assets. They can grow over time, and they can actually be sort of an ancillary retirement savings vehicle. So I think that there's a lot of power, especially for higher income folks, to use a health savings account in this fashion, where it's sort of a long-term savings vehicle. That's how I've been using my own HSA. And one thing I would say is that a big advantage is that those deductions come right out of my paycheck. And so it's like my 401k, where it's just an additional, very painless way to save and to add to my sort of ancillary retirement savings accounts. So one thing I would say is that HSAs aren't all created equal. So people should do a little bit of due diligence on an HSA. Many of us are kind of handed a health savings account if we're contributing through our paychecks, but you can periodically transfer out of that employer provided HSA if you've decided it's not that great into an HSA of your own choosing. Morningstar just in the past few years has added coverage of health savings accounts where we've been attempting to rate HSAs based on their attributes. So based on the quality of the investment lineup and what the savings account interest rates look like and all of those other features of HSAs. Most recently, in the most recent run of HSA research, Fidelity's HSA came out on top, but we'll be revisiting this annually.
I will be sure to link to that in the show notes. If I remember, close behind it was Lively,
Yes.
which I use myself. And I found those, I actually made a switch. I won't say where I switched from because I don't want to badmouth the provider, but I was with a provider I didn't like, and it was Morningstar's ratings that opened my eyes up to a few different options. So I really like those. And if you are interested in using an HSA, go ahead and check out the show notes. I'll have a link there. And one final note I'll make, Christine, as you pointed out, this is a good strategy that we're talking about for high income earners. So using an HSA can be for everybody, but there will be a lot of people who make their contributions and then go ahead and spend on current year medical expenses out of the account. And then oftentimes in a workplace, you have the choice between a PPO plan, a preferred provider. Well, I don't know what's the O stand for.
Organization, I believe. Yep.
Yeah. Or a high deductible plan. And the equation that I personally use in making the choice between high deductible plan and PPO is that if your medical expenses are going to be less than the savings in your premium, plus your employer contributions, plus your PPO deductions, then it's probably a good move for you from a medical expense perspective. Because just because you have a high income and you can afford to do this doesn't necessarily mean that the high deductible plan would be a better choice. You know, if you end up spending, if you're a regular visit, or I know if you have a child, for example, that's what we always tell people. If you're about to have a child or you have a big surgery coming up, you know, this high deductible plan may not be ideal. So it's a very powerful retirement planning tool. It is not for everybody. And I love, again, I appreciate that we're jumping a little out of order to group it there with those other retirement accounts, something that you do need to think about as you're looking at your 401k or 403b, 457, whatnot, and IRAs. We're only in January. So January was a big month.
We got a lot done.
I always tell people, oh my gosh, I could talk to Christine for 2 hours. Some of these, you know, as we're going through, I'm not going to spend quite as much time on. Yet the very next one I am going to touch on a little deeply as well, which is in February, conduct a review of your investments. So I know what that means to me as an advisor. I know what that means to me as chief investment officer. Christine, what does that mean to you speaking to people who do or don't have an advisor? You mentioned the X-ray tool I know from Morningstar, which is wonderful and that I do use myself as well. But what is someone looking for when they're reviewing their investments?
I think the key thing is to look at the asset allocation of the assets that you have earmarked for a given goal. That's probably the starting point. And the crazy thing about asset allocation is that the contents of your portfolio can slip around even if you haven't been making active changes. And so I think that's one thing people might not take into account, that many portfolios, because we've had such a great equity market, have slowly drifted to be more equity heavy. And for young accumulators, that's perfectly fine, may even be desirable. But for older adults, people who are approaching retirement, or maybe people joining this great resignation, it's been called, people who are thinking about hanging it up soon, they may have portfolios that are really quite aggressive given their life stage. And there's sort of this interesting thing that goes on where people, I think if they've been seasoned investors and they've made it through a few bear markets, they have a lot of risk tolerance. They feel comfortable taking equity risk. So someone who is embarking on retirement might say, well, that's fine. I know the market usually recovers. I'm fine with a 90% equity weighting, a 90% weighting in stocks. The problem is that if you are just about to retire and the market falls early on in your retirement and you have a too aggressive portfolio and you don't have cash, you don't have bonds in that portfolio, the risk is that once you're in drawdown mode and you're pulling from that portfolio, you will have no choice but to sell from assets that have diminished in value. So I think it's a really important juncture for people to check up on their portfolio's asset allocation. I've been saying it's a really important juncture for the past couple of years, and yet we've continued to see ongoing strength in the equity market. But I really do think it's a great time to check up on a portfolio's equity exposure. And then additionally, check up on the portfolio's positioning within its equity exposure. So if we've been kind of inert with our portfolios, if we haven't been making many active selections, chances are the growth side of our portfolio, the Apple stock and the other high growth stocks that have performed so well, those are hogging a bigger share of our portfolios. So check up on your portfolio style box exposure as well.
And one more thing I'm going to call out for people is particularly relevant if you have equity compensation of some sort, or for whatever reason, you have some individual stock positions that have grown over time. You mentioned Apple, great example, or any of the household names like an Amazon, Google, Facebook, where maybe you put some, or Tesla, maybe you put some money in and that position has grown, or maybe you do have that equity compensation and there are tax gains associated with it. But my personal feeling is always when an individual position is above 5%, I start getting a little uncomfortable. Now, I know we advise clients seriously no more than 10%. So I'm saying 5% is where I start paying a lot of attention and start game planning for ways to pare back that position, because individual stocks have a very decorated history of having permanent declines. And when those that have done very well, particularly those entering the top 10, the performance that they achieve leading into the top 10 is top 10 largest companies, I should say, in the stock market is good because that's how they got so big. The performance following the point at which they get into the top 10 has historically been pretty bad. I'll also note that when you're working for a company and you get your company stock, assuming that you like working there, you're probably going to think pretty favorably because you know what's going on. You see certain initiatives firsthand. And sometimes I think the higher up you are, the more illusion of control that you have over the outcome of the stock. So I know, Christine, you've written on both equity compensation and individual stocks quite a bit. Anything that you might add as people are doing portfolio reviews with concentrated positions?
Yeah, well, first of all, I would say I couldn't agree more. One thing I would say, Peter, is that oftentimes, especially with the big name individual stock positions, they're duplicating other exposure in the portfolio. So someone who owns Amazon and Apple alongside an S&P 500 index fund, well, they have amplified those positions with the individual stock holdings. But I also completely agree on the employer stock. I think that there are a lot of sort of psychological tricks that our minds play with respect to employer stock. There's sort of that loyalty that we might feel, or truly we might be believers in our company. That's the reason why we're there. I think another thing that can come into play is sort of this sense that it's mad money, sort of if you've just received it through stock grants or restricted stock unit grants, that it might just feel like, well, this isn't my real money. This is sort of the play money that I have. And that might be, but if you've been receiving multiple stock grants, that can add up to a nice chunk of your net worth over time. So I think it does make sense to look at how you might try to reduce that individual stock exposure and do so tax efficiently. And this is a place where an advisor can certainly provide a lot of help. And finally, one thing I would say about employer stock is that I often reference this research that my former colleague David Blanchett did on individual stock ownership, on employer stock ownership. And ultimately, he concluded that the optimal percentage of employer stock for someone to hold is 0, that it is not additive to most investors' portfolios. It's certainly additive to some investors' portfolios, but it dramatically increases risk in the plan. So if you can have an ongoing plan to reduce that employer stock exposure, I think that that's a sane thing to do.
Well, we have worked through January in which we're setting goals, tracking progress, looking at upcoming retirement contributions. We've reviewed the portfolio. The other items in February largely have to do with gathering tax documentation. And in March, leading up to tax day, is just a good reminder that if you didn't make some of these retirement plan contributions to an IRA or to an HSA, you still have until in 2022, April 18th, to make those 2021 contributions. So you always get a few extra months to add there. You also make mention of checking on inflation protection, which is something I think you could do as you're reviewing the portfolio. And then tax time comes and you need to know what to save, what to shred. For those of you listening along, I have an article that I will be sure to put in the show notes that goes exactly through that. You then kind of move in towards May towards assessing the emergency fund. And so when you're looking at your progress early in the year, and maybe you fill out a net worth sheet, I personally do. I spend more time reviewing the net worth sheet than I do my portfolio, than I do my cash flow. I mean, to me, I see everything in one place there. And the emergency fund, it's not built overnight. So if you don't have one, it can be daunting to hear someone say, yes, put 3 to 6 months or maybe even 12 months of your living expenses in cash. So when you, Christine, tell people to assess their emergency fund, what are the things that you want them to look for and think about in doing so?
You're so right, Peter, that number that you often hear thrown out, the 3 to 6 months worth of living expenses, it seems so daunting, especially for people who are just starting out. And the key point I make there is you're not looking at your current living expenses necessarily to set that target. Look at what you could get by on in a pinch. So if you lost your job, for example, you might drop your gym membership. You might not, but you might drop your dog walker because you'd be home. Look at the ways that you could really reduce your budget to try to make that emergency fund more manageable. But I love the idea of people customizing how much they need based on their own situation. So I think younger folks with roommates, for example, they have a lot of flexibility built into their lifestyles where they could make dramatic changes if need be. Whereas people who are more settled in their careers, maybe you're the primary earner in your household and you have children who have needs that you have to fund on an ongoing basis. Well, you're someone who has the need for a higher emergency fund. And I would say also for people who have higher incomes, I would definitely park a higher amount in emergency funds because oftentimes we see that people with higher incomes have more specialized careers. It's more difficult for them to replace those jobs if they lose them. And they may want to be pickier about the job that they eventually take. So I would target a higher amount of emergency reserves, more like a year's worth of living expenses. So definitely customize those and also look at other sources of funds that you could fall back on in a pinch. So do you have a home equity line of credit that you could potentially tap? I know cash value on life insurance is often thrown out as an additional source of cash reserves. So look at non-portfolio cash flow sources as well as just those liquid reserves that you might have parked in a money market fund.
Which becomes really important for you. You call out in this sort of month of May when they're looking at the emergency fund for retirees to assess those liquid assets. And just actually before I jump into the retired one thing I want to mention on these emergency funds is that those who are, as you mentioned, high income will have a higher dollar amount there. But if your financial house is really in order and very strong, this becomes not just an emergency fund, but a flexibility fund, an opportunity fund. You don't always want to treat it as a piggy bank, but when you have a job opportunity that comes along, it's not an emergency. It gives you flexibility. It allows you to go work for a company that maybe the income's less, but the equity compensation's more, or to start a business, or just to make an investment that's a higher return that without that pile of cash, you wouldn't have the opportunity. So I don't think that people need to be afraid to use their emergency fund opportunistically, but that's why you assess it along with the rest of your finances. So when that moment comes, you can make an informed decision. With retirees, you're halfway through the year almost at this point as we're walking in order, and you have a general sense of what is going to happen throughout the rest of the year, what your cash needs might be. And we typically at PlanCorp like retirees to retire with 1 to 2 years of cash on hand, which is a big number. And a lot of that is to try to eliminate sequence of return risk. So a bad market early in your retirement is going to permanently impair your ability to generate total returns from that portfolio over time to support the lifestyle. But you mentioned already a couple different liquidity buckets beyond just cash. You mentioned life insurance value. Some people will look at home equity lines. Any other areas where retirees might be looking for liquidity and assessing their opportunities?
Well, I love the idea of, as you said, Peter, of retirees having those liquid reserves set aside. And I think that the key thing I would point out is that even though cash yields are very, very low, I think that the yield differential on cash versus fixed income assets is also really low today. So while I do think that retirees do need to have bonds in their portfolios as well, I wouldn't be shy about retirees holding ample cash of 1 to 2 years worth of living expenses. But retirees might also hold some ancillary short-term assets. So a good quality short-term bond fund, I think, for example, could be kind of next line reserves if the cash assets were depleted. So I would look at, a Fidelity short-term bond or a Vanguard short-term bond index as sort of a next line reserve account.
Well, and as we've moved in, I mentioned you're mid-year within the line items here, and some of them are portfolio review, like reviewing an investment policy statement or making sure that your portfolio is aligned with your financial plan. The one thing I think that really sticks out here among some of the summer month items you have is creating a retirement policy statement. So tell us a little bit about that.
Right. A lot of people have heard of an investment policy statement, which documents your overall approach to managing your portfolio. So your asset allocation, what you're looking for in stocks and funds and ETFs that might make it into your portfolio. A retirement policy statement is something that I see as kind of a complement to an investment policy statement. And I think it's something to create as retirement approaches. So it's basically a documentation of your financial plan in retirement. So it would document your Social Security filing date, for example, when you expect to file for Social Security, what sort of distribution plan you'll use for your portfolio. So will you be old school with that portfolio where you're kind of relying on current income distributions to fund your cash flow needs, or will you potentially sell appreciated portions of your portfolio periodically, or will you use kind of a hybrid where you'll rely on a combination of income distributions as well as periodic rebalancing to fund your cash flow needs? And I think it's also important that that retirement policy statement lays out how much and how you will spend from that portfolio on an ongoing basis. So we recently completed a big piece of research about in retirement withdrawal rates. I think a lot of people have probably heard about the 4% guideline for retirement portfolios. Our view at Morningstar is that because we expect that the next decade, especially for the markets, might not be that great, that investors might want to be more conservative than using that 4% as an initial withdrawal amount, that they might want to start in sort of the mid 3% range instead. So the idea of this retirement policy statement is that it's something that augments your investment policy statement. You still need that investment policy statement in retirement, but you also have this retirement policy statement that lays out your approach to decumulation.
Well, that's fantastic. I absolutely love that. Naturally, we're doing that sort of planning with clients, but if you don't have an advisor, it is so important to have a plan, because when things go awry or seem scary or become disorganized, you can always revert back to the plan that you made thoughtfully and carefully to follow through thick and thin. So I really like that, the retirement policy statement. You know, near the end of the summer, you focus a lot of the to-do items on estate planning, and everybody needs to have an estate plan, regardless of their age, wealth, health, life stage. The degree or intensity or magnitude of the estate planning certainly varies from person to person. And it seems like, there might be some changes to estate tax exemptions in the relatively near future. And if not, there's a clause for it to sunset a few years out. So I would say if you have an estate plan, we're getting pretty close to a point where you ought to reach out to your attorney to review that upon some of these things. You don't necessarily want to pay for the service prior to decisions coming out of Congress. But, you know, I'm personally, Christine, a really, really big proponent of hiring someone who only does estate plan work rather than a jack of all trades attorney. Also trying to avoid the online options. I know that the online options exist and they are getting better. And I would say that if you're going to use one of those online options, just recognize that they're not perfect and there are disclosures. But one of the things that you call out that a lot of people forget, in my experience, is reviewing the beneficiary designations. And doing the digital estate plan, which I had never actually seen that before. So I had to click into the article and see a little bit more of what you meant there. But things change over time, and you might have new accounts and they may not be titled correctly or the right beneficiaries there. The digital estate, maybe just quickly talk to people who are starting to accumulate more digital things, more personal accounts. Maybe talk to people a little bit about what they ought to be thinking about there.
Yeah, this is such a rapidly changing space, Peter, because the space now includes crypto assets, which are increasingly part of people's portfolios. But the digital estate plan really relates to all of the digital assets that you might have. So that includes logins for various accounts. And I think, people may be aware that sometimes if someone passes away, their LinkedIn page might continue to be out there. The idea is that you are entrusting your loved ones to make some decisions about those accounts once you're not around to manage them anymore. So I think it's an important and will be an increasingly important aspect of estate planning. And certainly as people have digital financial assets like crypto assets, I think that'll become increasingly important. How do your loved ones, how do those you entrust with making financial decisions, if you're unable to do so, manage those accounts?
And there was a part of the checklist that was earlier in the calendar schedule that I somewhat glazed over, which was creating a master list for people to reference. And this can be a good place to say, hey, these are my passwords and such. And for those of you watching on YouTube, just below me is my fire safe, which my wife makes fun of me. I never actually lock it because there's there's valuable personal identification things, but if there's a fire, I just don't want to have to go get them. And that's where we keep a few key passwords and sort of sorting out. It isn't everything. It's not as comprehensive, Christine, as the list that you have laid out. I sort of trust my wife to call our financial advisor and they'll have a lot of it. But with things like crypto assets, with things like social media accounts, there needs to be at least one way for people to know where all your passwords are, even if it's just the password to your password manager, right, somewhere safe and secure there.
And a password manager is the gold standard in all of this, that if you use a password manager, your data are much more secure than if you're kind of keeping that spreadsheet updated on an ongoing basis.
Absolutely. So in September, you have reviewing your long-term care plan. And in October, you have kicking the college funding into high gear, two very different things for people in different life stages. And then, in November, conducting insurance review, which you can do with the agent who sold you a policy, or the broker who sold you a policy. But as you get into December, it's that time of year where, again, you're looking at your portfolio again, but also people are making gifts, both charitable and to family members. You have spent time about giving as well as the softer side of money. I would love if you talked a little bit about that here and what you think people could do in December when they're reaching this checklist item.
Yeah, it's really a terrific time to take a look at charitable giving. We often urge people to give throughout the year if they can, but definitely if you are trying to keep track of your charitable gifts, sort of year end is a good time to do so. You can take advantage, especially if you're a retired person who is subject to required minimum distributions. One of the best charitable giving tools is to use what's called a qualified charitable distribution, or a QCD. And this is a way of transferring assets from your IRA directly to charity. And that serves multiple goals. One is that it makes a charitable gift, but the other is that the amount that you contribute to charity, up to $100,000, satisfies your required minimum distributions. It also does not affect your adjusted gross income, so it reduces your taxable income. And importantly, it also reduces the amount of your portfolio that's subject to required minimum distributions on an ongoing basis. So we always urge people who are 70 and a half or older to take advantage of the QCD if they're at all charitably inclined. Other people who are not 72, so younger people who are making charitable gifts, might take a look at what's called a donor advised fund. These have really taken off over the past several years, and the basic idea is that you are contributing assets, contributing appreciated stock or even mutual funds directly to the donor advised fund, and you earn a tax break on the year in which you contribute to that fund. But the nice thing about the donor advised fund is that you can actually take your time and be deliberate about making those contributions. So even though you earn the tax break on the year in which you make the contribution, you can take a bit of time to get the money put to work with charities. So I think that this is a strategy that investors have been embracing. Donor advised funds can actually take illiquid stock and deploy it and allow you to then contribute the funds to charity. Certainly you can contribute appreciated stock directly to charity as well, but a donor advised fund might make that simpler, especially if you have less liquid stock that the charity may not want to deal with.
So my favorite thing about the donor advised fund is that you only have one tax letter to keep track of. And so if you're charitably inclined and giving several $1,000s a year, but all in little chunks, and you have to, come tax time, find all the tax letters, all the receipts, that one donor advised fund contribution is the only documentation you need to keep. And then you can dole out the gifts and not have to keep track of as many things. And I also know, having served on some charitable boards, both large and small, is that if you're giving to small organizations and you want to give appreciated stock, they're more than grateful to have the gift, but some people just aren't set up as well to receive stock. And so receiving the gift from you via donor advised fund just makes it a little more easy to digest that gift. And this is really important with small organizations where there's only a handful of staff. If you want them to spend as much time on the mission as possible, a cash gift, whether it's cash or coming out of a donor advised fund, is far easier for them to spend their time doing the mission work than trying to take care of a stock gift and get it liquidated. And if they don't have an account, they have to go open an account. So just food for thought there for people, the convenience level for yourself as well as the convenience level for the charities themselves.
I would amplify that, Peter. I think that makes a ton of sense. One thing I would say, though, is that donor advised funds are not all created equally. And so do your due diligence there as well, because there are expenses associated with these funds. Some of them are quite inexpensive. So I think Vanguard's arguably is the best in my view. But just do your homework on what you're paying in terms of administrative costs.
In Morningstar, there's no rankings of those yet, are there?
No, but we've been talking about it. And my colleague, Amy Arnott, has done some great work where she's looked at some of the big ones. And I think she has concluded that Fidelity's and Schwab's and Vanguard's, which are kind of the big three at this point, they're all very serviceable, whereas some of the other donor advised funds aren't quite as good.
Well, Christine, as we're running up on time here, we've largely gone through the whole list. And again, I'll be sure to link to it in the show notes at thelongterminvestor.com. But there are two questions that I ask all of my guests. The first of which you have actually answered very publicly in a book called How I Invest My Money. And actually, my next guest is Brian Portnoy, who's one of the authors who compiled that book. And so certainly listeners, you can tune in for that and we'll hear a little bit more about that. But the one question I ask people is, what's in your portfolio? How do you invest your money? So I don't expect you to regurgitate all of that, but maybe give people a little bit of a taste. And I will link to the book so that people can read your chapter within that book.
Sure. It's a good question, Peter. And I think people should ask this of their financial advisors or whoever they're looking to for financial guidance. My portfolio is pretty minimalist, and that has been an active choice. I think as we get on in our lives, things have a tendency to get a little complicated, and I have tried to rein that in. So I invest in my company 401k plan. My husband invests in his company 401k plan. He's primarily an index fund investor in that plan. And within my plan, I actually have, I would say, probably a majority of active funds. I would say that having been a fund analyst for many years and eventually heading up our US team of fund analysts, I think I'm a pretty good fund owner and fund picker. So the funds I have, big positions in my account are Vanguard International Growth. I have American Funds, Washington Mutual, a number of active funds. And the key there is that I've focused on really low cost investment funds. And then within our taxable brokerage account, we have invested primarily with Vanguard, where we have Vanguard's municipal funds, the cash account, as well as intermediate term municipal fund. And then we have just a handful of funds, of equity funds. We have Vanguard International Value in our IRAs, and Vanguard Developed Markets in our taxable brokerage account, and Vanguard Prime Cap Core. So we've tried to keep things pretty skinny down on an ongoing basis. And I would also say we talked about employer stock, and I've been lucky to receive Morningstar stock over the years, and it's done very well and is arguably too large a share of our portfolio, but we've been trying to divest of that in a tax efficient way over the years. So that's kind of my portfolio plan in a nutshell. I really do try to keep things pretty stripped down on an ongoing basis. I like to keep things simple.
Me too. And thank you for sharing that, Christine. Just real quickly on your chapter within the book, my favorite thing is that if it's not right out the gate, you mention pretty quickly that you're not that passionate about investments. So those who are hearing you talk about your career and your lifetime as a your career as a fund analyst and your role even in what you're doing now that mixes the planning with the investing, that probably will surprise those. And I think it also goes to show that the investments is just one piece of it all. It's certainly my primary focus at PlanCorp, but at the end of the day, I don't look at my portfolio really ever. I looked at it the other day to see what the value was so I could fill out my net worth worksheet, but that was about it. So, I appreciate you sharing with the audience a little of how you think about that. The last question I have for you is, what does it mean to you to be a long-term investor?
I think the key thing is just to stay focused on goals and let those lead the way and balance that alongside decisions that you might need to make to deliver peace of mind. And so I think that continually revisiting goals, how you're doing on your proximity to goals, let that be the guidepost. Don't let how you performed relative to the S&P 500 or relative to your brother-in-law guide the way. Look at how you're doing relative to your goals. And as you advance in your investment career, give greater priority to peace of mind, because I think that becomes really an important part of reaching goals, is not only did you hit that financial goal, but also did you find comfort along the way. So that to me is what being a long-term investor is about.
Fantastic. Christine, where can listeners and viewers find you?
Well, I'm easy to find on Morningstar.com. I've got something up there almost every day, either a video or an article. On Twitter, I tend to be an active participant. I really enjoy the discourse that happens there. And my Twitter handle is @Christine_Benz. And then our podcast, which you so nicely mentioned, Peter, is called The Long View. This is something that my colleague Jeff Patak and I work on, where we interview a thought leader in investing or personal finance or retirement planning.
Again, thank you so much for joining me. This is really exciting to have you on the show. I'll be sure to link to all those things in the show notes at thelongterminvestor.com. If you're viewing this on YouTube, please like and subscribe so that you don't miss another one of these great interviews. And if you're listening on the podcast, please leave me a comment, because I'm reading those and trying to adapt to what it is you want to hear and who you want to hear from. But until next time, thanks for joining us into long-term investing.